The Big Short investor bets against Nvidia as U.S. markets face a liquidity crisis. Last week, amid a flurry of tech earnings reports, we warned of a potential market shift. This week, U.S. stocks opened lower and continue to fall, experiencing a significant pullback driven by multiple negative factors. A crisis triggered by drying liquidity is now flashing red for the markets. Michael Burry, the real-life inspiration for The Big Short, has openly declared short positions in two AI darlings, Nvidia and Palantir. This video breaks down the current market predicament, what challenges it faces, and how this liquidity crisis could structurally reshape U.S. stocks. So what's spooking the markets? 1. The liquidity crisis. As of November, the U.S. federal government shutdown has reached its 35th day, tying the record for the longest in history. This is the root of the liquidity crisis. Here's why. During the shutdown, the U.S. Treasury, to maintain basic operations and meet debt payments, has been forced to hoard cash. It has significantly increased its cash balance at the Federal Reserve, known as the Treasury General Account, TGA. This effectively tightens market liquidity. The TGA balance has ballooned from $300 billion to $1 trillion, a multi-year high. This has effectively sucked nearly $700 billion of liquidity out of the market, equivalent to the Fed unexpectedly hiking interest rates by 100 basis points. Consequently, even though the Fed is in a rate-cutting cycle, the Secured Overnight Financing Rate, SOFR, is spiking. Market liquidity is on the verge of drying up. 2. Impacts on the real economy and multiplying black swans. Again, due to the shutdown, the release of crucial U.S. economic data has stalled. Furloughed government employees have pushed unemployment higher, and visible chaos is spreading across industries. For instance, disruptions in aviation information systems are already causing major incidents. Inflation is beginning to rebound. These ripple effects are now hitting the federal. With rising inflation and unemployment and a lack of reliable data, the Fed may be forced to pause rate cuts at its December meeting and adopt a wait-and-see stance. The market-implied probability of a December rate cut has already plunged from over 90% to just 60% and may fall further. 3. The AI sector's massive capital expenditure faces market skepticism. As discussed in our previous video, major tech earnings last week highlighted a common red flag: disproportionately high and ever-increasing capital expenditures. What was a bullish signal in Q2 has become a major concern this quarter. As the macroeconomic environment deteriorates, market risk appetite is shifting rapidly. Voices warning of an AI bubble are growing louder. The news of Michael Burry's short bets on Nvidia and Palantir has further fueled this sentiment. The psychological impact on investors far exceeds the actual financial effect, causing a broad reassessment of risk assets. Even mighty AI is not immune. Market impact and outlook. The root of this crisis remains the short-term liquidity drain caused by the U.S. government shutdown. The solution lies with the same entity that created the problem. Short-term. The key is whether the U.S. government can end the shutdown this month. If it reopens, a significant portion of the drained liquidity would flow back into the market, likely triggering a rebound in both capital and sentiment, potentially reversing the current trend. Medium to long-term. This crisis may have fundamentally altered investor risk appetite. Excessively high U.S. stock valuations, economic uncertainty, and the massive, potentially unjustified spending on AI could become the most significant vulnerabilities for U.S. markets in the coming year. The Fed's interest rate decision in December will be pivotal in setting the tone for risk appetite in 2024 and demands our close attention. That's all for today. Stay vigilant.